Hello and welcome to Bricks Videos. This is the channel where we answer all your questions related to property buying. Today's video is on calculating long-term capital gains tax on property sale. From our previous video, we all now know about the basics of capital gains. Please click on the link in the description box below to watch our previous video which explains about capital gains and its types. So now, let us move on to understand how the long-term capital gains are calculated.
Let us assume that the house was purchased for ₹40 lakh and the year of purchase was 2010-11. Now let's say the house was sold for 70 lakh during the financial year 2018 and 19. To compute long-term capital gains, you have to deduct the indexed cost of acquisition and indexed cost of improvement, if any, from the net sale consideration. Indexed cost is calculated by multiplying the cost of acquisition or improvement with the cost inflation index of the year of the transfer of the capital asset. So to calculate long-term capital gain, firstly let's consider the CII value of the financial year during which the property was first held and the property was sold, that is 2010 and 11 and 2018 and 19. We suggest all our viewers to click on another link provided in the description box below to know more about CII for all financial years. So now, coming back to the example, CII value of the financial year 2010-11 is 167 and for the financial year 2018 and 19, the CII value is 280. Now the CII of the year of sale has to be divided with the CII of the year of purchase. That is 280 divided by 167 multiplied with 40 lakhs. 40 lakhs is the price for which the property was purchased and it gives the indexed cost of acquisition, which becomes 67 lakh 6,586. Also, if there are any improvement costs incurred during the period for which the property was held, then indexed cost of improvement needs to be calculated the same way indexed cost of acquisition was calculated, but by replacing CII of the acquisition year with CII of the year the improvement was made. Now we are in the final stage of the calculation. Let us get less confused and deduct net sale consideration value with the indexed cost of acquisition value, that is 70 lakh minus 67 lakh 6,586, which becomes 2 lakh 93,414, which is the long-term capital gain in our example, assuming there was no other expenditure during the period for which the property was held. So long-term capital gains tax is calculated at 20% of the gains made, which becomes 58,682 rupees, assuming there is no capital gain tax exemption benefited by the seller.
Please note that the CII values for the properties sold before the financial year 2016-17 are different compared to the properties sold post 2016-17, and you can check the same by clicking on Click Here option at the bottom of the CII list provided on the website of Indian Income Tax Department. So we urge our viewers to check the difference before calculating the long-term capital gains. Now before we end, what if the seller doesn't make any profit or capital gains on the sale of the house and instead suffers capital loss? One of our videos on capital loss has an answer to this muddle. Please do watch our next video on capital loss by clicking on the link in the description box below. This brings us to the end of this video. We hope we have answered your queries relating to this video. If you have any questions, please leave them in the comment section below and we respond to every comment we receive. Thank you for watching. Don't forget to like and share our videos if you like our work, and don't forget to watch our related videos.